Well, the Reserve Bank's move to a new historic low for interest rates seems to have left no one happy. Mortgage holders are squealing because the banks aren't passing it all on, while savers feel they're being further punished, to say nothing of what a cash rate of 1.5% might tell us about what the shape the economy is in. Even lower rates will force even more people to accept even more risk, making a crowded market for income stocks. Think the big banks, Telstra or Transurban, even worse. Well, Roger Montgomery from Montgomery Asset Management is with me now in the studio. Roger, hello there.
Hi, Ticky. How are you?
Well, what does this rate cut, first of all, tell us about the economy at the moment?
Well, it really has nothing to do with our local economy other than the fact that there aren't any inflationary pressures, and perhaps there are some deflationary pressures. But this is really all about trying to get the Australian dollar down to a more competitive level, and it didn't work. Rates were cut and the Australian dollar ended yesterday slightly higher than where it started. Malcolm Turnbull's asking why the banks, for example, aren't passing on the full rate cut. Well, there's two reasons. The first one is that APRA is going to impose a higher stable capital requirement for the banks. That means they have to move more of their funding into long-term or ask for long-term funding. That's more expensive than short-term funding because it's safer and more stable. And so that's why we're seeing, for example, deposit rates go up, because that's more...
Well, that's a good thing for savers, but presumably that puts pressure on their margin, their net interest margin.
Except that it won't last for very long. It's done to actually appease the government because the full extent of the rate cut wasn't passed on to on mortgages. And the reason that wasn't is because of the pressure on net interest margins. So as interest rates get lower, the lower they go, the harder it is to bring down your funding costs, because rates are already very close to zero, so you can't compensate. And so as interest rates go down, less and less of that cut can be passed on to mortgage holders while maintaining your profit.
So banks, however, they were smashed today on the market, and we've just heard the Prime Minister and indeed the Treasurer both warning that banks, that once again they've got this social licence that the public has given them to operate, with high moral conduct, I suppose, and passing on these rates would be part of that. That's the implication.
Well, unfortunately, that's just not going to happen. The banks are under pressure on a number of fronts, and we talked about this earlier in the year. Their capital adequacy requirements are being lifted, and that reduces their profitability. Their credit growth is under pressure because we've got a mature property market now, and of course net interest margins are under pressure because the interest rates are declining as mortgage rates decline, but their cost of funding is not declining, and part of the reason is actually all of this talk about Australia losing its AAA credit rating, and also a very bubble-like property market. So offshore lenders aren't willing to lend at cheaper rates to Australian banks.
So just looking at savers, while we've got something of a rise there, isn't it very tempting at the moment to take money out and put it in sort of riskier, more high-yielding? I mean, well, obviously you're not offering specific advice, but generally...
I'll make it very, very clear for investors. Over the next 3 years, one of two scenarios will ensue. It will be you pay a higher price for assets and you're going to get a lower return because, of course, the higher the price you pay, the lower your return. Or something more violent and extreme occurs, which still produces a low return. So either scenario, low returns, one of them relatively stable and smooth and just steady as she goes, one much more violent. I'm increasingly leaning towards the idea that some sort of a correction in asset prices will occur in the next 2 or 3 years.
Briefly, why shouldn't we manage our expectations now as investors? Because inflation is low, wages growth is low, costs are not increasing at the same rate. Everything should be expected to be lower, surely.
Indeed, but we've got high asset prices because assets are valued using a discount rate, and when the discount rate is guided by the bond rate, and we have historical low bond rates, that means asset prices are justified to be high, but they're not supported by earnings growth.
World's gone mad. Roger Montgomery, thank you very much for joining us.